Let's get in Manpreet Gill, Chief Investment Officer of Africa, Middle East, Asia and Europe at Standard Chartered with us. Manpreet, thank you so much for waiting by patiently. We just had to finish off some of the stocks before we get to you, so really appreciate this, you joining in so early in the morning. Manpreet, but it's great to look at mornings these days because across the world, risk assets seem to be moving higher in anticipation of the rate cut or the easing cycle. Are you constructive risk assets like equities or are you cautious?
Morning. Yes, I think we are constructive, but I think we're looking at exactly the same balance to say, look, economic growth, earnings growth, all of that argues that risk assets should remain well supported. And the fact that we're getting now to the point where Europe has already, major central banks in Europe have already cut rates, the Fed, in our view, will start cutting rates. That should all be a big tailwind. I think what we're trying to balance that is, how much of that is already in the price. Because if I look at the market expectations of Fed rate cuts, a lot of those are already in the price. And that's, of course, coming at a time in the year when September says seasonally tends to be a much softer month. And obviously, we have rising uncertainty in the form of elections, geopolitics. So that's the reason why we've taken a little bit more of a balanced approach, saying, look, the baseline path still is all of these factors, particularly rate cuts, should prove to be a tailwind. But we just want to balance that a little bit more than usual with, owning high-quality bonds on the side and indeed gold. So I think that's really the way we're positioning ourselves at this point in time, particularly after being overweight in a year when equities have done very, very well in India, but indeed almost in all major markets around the world.
Keeping risk reward as your backdrop and a Fed rate cut around the corner, buy the news, sell, or buy the rumor, sell the news. What are you doing with India? We've done well. We've done decently well year to date. Everything seems under control. What's the trade on India right now?
Well, I think on India, our regional views haven't changed. I think what we've done is sort of trim at a global level, just how large our exposure to equities is. But within Asia, in our view, the case for India remains, or Indian equities remains pretty strong because it's still, in the region, the market where earnings growth and economic growth is most compelling. Yes, you do pay a price in terms of relative valuations, but we still think that's far more compelling than, more inexpensive markets in North Asia. But in North Asia, in China, we still have growth concerns. How that sort of policymakers balance out the need for supporting growth with the ideally an avoidance of reinflating more bubbles, and many other regional markets are more sort of sector specific. So Korea, Taiwan, of course, being more semiconductor sector specific. So in that context, we think Indian equities still stand out quite positively. We still like Indian bonds as well. So we think India is not just an equity story. The bond yield is still attractive relative to other emerging market local currency markets. So on both fronts, we still think India makes a compelling case on regional grounds. I think it's just about how much risk you want to carry at this point in the year, especially after both have performed quite well year to date.
Manpreet, just getting your sense of the question of valuations, and we keep talking about it here from a global investor interest perspective also, it becomes a big conversation. Is it such a big deal right now in terms of how richly India is valued in terms of equity?
Okay, something we do need to watch quite closely because, look, on the positives, in rising markets, usually valuations go up, right? We see that in every cycle, nothing wrong in that. Investors usually will pay a much, much higher multiple for a positive story. And usually in emerging markets, you tend to see the average rating sort of get re-rated higher as the longer term outlook improves. The other way we've been looking at it is to say, are valuations justified by current earnings and productivity? So looking at price to book versus ROE, actually Indian equities together with the US, they stand out as having elevated earnings, but arguably they're justified by the higher return on equity compared to what you get elsewhere in the world. Now, there are some longer term questions of, okay, if you add more of these valuations, what does that mean for the next sort of 10-year type returns? But it's not a reason by itself to say, look, so don't add more today because it doesn't tell you anything about the next 6-month return. So we think they're on the elevated side, no doubt. It's something we want to keep a close watch on, but we do think they're justified by the return on equity. We do think they're justified by the growth outlook. So I think it's really about balancing it together with all the other factors rather than worrying about valuations alone.
Thank you, Manpreet. We'd have loved to chat with you longer. Hopefully, we can have an extended conversation closer to the Fed rate cut. But until then, have a good week and we'll see you soon.